Hello everybody, Assalamualaikum warahmatullahi wabarakatuh. Welcome this video with me Exia Vita. How are you today? I hope you all are well. Okay. This video, I'll give you an introduction to accounting by telling you story. It's a story about Claudio and how he ran his business in Italy. Before we start, let's just get clear on what accounting is. Accounting makes it possible to systematically record, analyze, and report important financial information, and communicate the financial health of a business to all interest parties. It's called the language of business and it's the backbone of any company because every business needs reliable data to make informed decisions. But what does that really mean? Let's just take a moment to make this a bit more transparent and understand the basic of accounting. So let me tell you about Claudio. Imagine where in Italy, which is also one of my favorite places, a nice big city where a man called Claudio is selling souvenirs to tourism. He only sells one item, a beautiful plate made from colorful glass. In the morning, he leaves his home with 1,000 euros and goes to manufacture and the souvenir. Each plate costs the euro. So Claudius buys 1,000 pieces with his 1,000 euros. He walks to the beach and sells the plates to tourists for 5 euros a piece, and by noon he sold out. He gets home happily and repeats the same process the next day. After a month, he wants to know how much the business made. What if he sold more than one item? Which one was more profitable? Would this make sense to expand his business, like rent a fixed tent at the beach, without a way of recording the daily activities of business? He's not going to be able to answer this question. Accounting makes this possible. Not only will its financial transaction be recorded, but Claudio will also get detailed report summarizing his financial performance. We call this report financial statement. Let's start with Claudio probability. If you want to find out about a business probability, you go their income statement. This is one of the main financial statement. There you can find out how much sales a business and had in a certain period, with cost, and that was a resulting profit or loss. There is another name you might hear for the income statement. Do you know what is P&L for profit and loss? It's a fairly simple business model, and the P&L for Claudio business would look like this. 1,000 plates for 5 euros each. That's what we call sales of our revenue, with 5,000 euros. The plates he sold he didn't get for free, right? The incur cost to buy them. Each plates cost him 1 euro. Therefore, in total, his costs were 1,000 euro. We call this the cost of goods, which we need to deduct for revenue. To keep it simple, we don't consider any other costs for now, like fees and tax. If we add this up, we can see that Claudio made a profit or a net income of 4,000 euros. That's now a simple income statement would look like. Next, we are going to take a quick look at the second main financial statement, the balance sheet. The balance sheet shows which assets the company owns, the liabilities it owns to others, and the equity that belongs to the owners. Assets are usually things of value or resources the company owns and uses. For instance, land and buildings, office equipment, inventory, or cash, just to name a few. Liability are that you own to others, for example, a bank loan, or that you own to our supplies or goods, or to the IRS in tax. The third component is equity. This is a bit more abstract. It's the residual amount that would be left in the company sold all its assets and paid off all its liabilities. In other words, it's the difference between total asset and total liabilities. This leftover money belongs to the owners of the company. In the balance sheet, the assets are on one side and equity and liabilities are on the other side. If you draw a line between the two and one top, it looks like a T. This is what accountants use to visualize accounting transaction. It's a very helpful tool, and we're going to come back to this T account all the time. You can see that the left side of the T is just as big as the right side. That's because everything the company owns, so its asset, was purchased either from debt, so somebody else's money, or its own money, meaning equity. For money to go to one account, it has to come out of another. We call this a flow of economic benefit from a source to a destination. We already said that asset means liabilities equality. If we rearrange this like this, we get asset equal liabilities plus equity. But sides are always in balance, hence the name balance sheet. And that is the foundation for any accounting system, the accounting equation. The total amount of asset equal total liabilities plus equity, but sides are in balance. With that in mind, let's see how the balance sheets look like for Claudio. A balance sheet is always created at a certain point in time, like at the end for the business year or at the end of a quarter. In your example, it's the end of Claudio's business day. Claudio starts out with 1,000 euros in cash, which is also the money or equity he puts into the business. The cash on the left side equal equity on the right side. The balance sheet at this point is in balance. Then he cash in the morning to buy the colorful plates. The plates are what we call his inventory. In the process, his cash got reduced to zero, but in exchange, he received another asset inventory. He didn't get richer or poorer by that, right? The total amount of asset is 1,000. But of course, his equities too. After he sold the plates 5 euros each, he ended up with 5,000 euros in his pocket end of the day. His inventory is gone because he sold all the plates to the tourists. At the end of the day, his inventory value therefore is zero. He doesn't have any more plates. If we look at Claudio's balance sheet at the end of the day, we can see that the total value of asset the left side is 5,000 euros. That's the cash he come home with. On the credit side, we only have 1,000 euros. The balance sheet is out of balance. As we know, this can be. But side always need to be in balance. So what's wrong here? The missing component is the profit he made during the day. If you go back to the income statement, we see that Claudio net income was 4,000 euros. This will be end to equity. Why? Because due to this successful business, he made the business more valuable. When he started out the day, it was worth only 1,000 euro, which was the money he put into the business when he walked out the door. When he come home, he had sold all his plates with a profit of 4,000 euros. So his business is now worth more, which is reflect in a higher equity. Net income is the link between the income statement and the balance sheet. So when we end the profit of 4,000 euros, he achieved to equity. Also, the right side gets to a total of 5,000 euros and the balance sheet's balance like it sold. So that's how it would look like for Claudio at the end of his successful day at the beach. I hope this video was helpful for you get familiar with account basics. Okay, thank you for watching my video. There are wrong words and speech, please forget. Wassalamualaikum warahmatullahi wabarakatuh.